Hello, now we are going to start with our day 11. So let's start with our day 11. So this is the 18th sum which I will be doing for you all. So right now we are starting with our 18th sum. So Beta Limited has furnished the following information: the earning per share, the dividend payout ratio, the market price per share, the rate of tax, the growth rate of dividend. The company wants to raise additional capital of rupees 10 lakhs including a debt of 4 lakhs. Okay. The cost of debt before tax is 10% up to 2 lakhs and 15% beyond that. Calculate after tax cost of equity and debt and the weighted average cost of capital. So this is a smaller sum and it might come for maybe 5 marks in your paper. So we are going to solve it right now. So what they have said is that first I will find the cost of debt for you all. So let's find the cost of debt. So I'll move this side. Okay, I'll move this side. Okay, so the cost of debt is the company wants to raise an additional debt of 10 lakhs. So the company wants to raise a debt of 10 lakh rupees. The company wants to raise. So the debt component is of 10 lakh rupees. So the company wants to raise an additional debt of 10 lakhs, which includes the company wants to raise an additional capital of 10 lakhs. So I'm sorry, the company wants to raise an additional capital. So the total capital, the total capital that the company wants to raise is 10 lakhs and it includes debt of 4 lakhs. Okay, so it includes a debt component of 4 lakhs. So 4 lakhs is our debt component. So the remaining component we will assume it to be equity, and so the equity component would be 6 lakhs. The capital structure is divided into two parts. One is the debt component and other is the equity component. Then the company wants to raise an additional capital of 10 lakhs. So the capital is 10 lakhs. Okay, it includes a debt of 4 lakhs. So the rest 6 lakhs would be equity. So first, the cost of debt before tax is 10% up to 2 lakhs. Okay, so here the debt component we know that it is 4 lakh rupees. So total I am going to borrow 4 lakh rupees. So the cost of debt before tax is 10% up to 2 lakhs. So the 2 lakhs, the first 2 lakhs I can borrow it when at the interest rate of 10%. Okay, the cost of debt before tax is 10% and up to rupees 2 lakhs and 15% beyond that. And for the remaining portion of 2 lakhs, right, for the remaining portion of 2 lakhs I will borrow it at the rate of 15%. So what they want is compute after tax cost of equity and debt and find the weighted average cost of capital. So it is a similar sum which we have done. I think earlier also we had done this kind of sum. So first the cost of debt after the cost of debt at 10% will be, so cost of debt will be interest, then give the effect of tax savings, so 1 minus tax. Then it might be a loan which you have taken, so the debt component will come down, that is the loan amount, into 100. So on 2 lakhs 10%, so 20,000 will be the interest part which I will pay. 1 minus, how much is the tax rate? The tax rate is 30%. So 0.3 I will take it as tax. And the debt component, how much loan I have taken? I have taken a loan of 2 lakhs. So the debt component is 2 lakhs, and this I will multiply by 100. So I'm solving it right now. 20,000 into 0.7 divide by 2 lakhs. So percentage is 7%. So 7% is the cost of debt after tax, that is post tax. So this part I have done it. So this part we are moving it for the other portion. So cost of debt at how much? At 15%. So cost of debt at 15% we are going to calculate. So cost of debt will be interest, give the effect of tax savings. So 1 minus tax, divide by the debt which you have borrowed, and multiply by 100. So on 2 lakhs 15%, so on 2 lakhs into 15% is 30,000. So 30,000 is the amount of interest I will borrow. 1 minus, how much is the tax? The tax rate is 30%, which I will take it as 0.3. And how much debt, how much loan I have borrowed? I have borrowed a loan to the extent of 2 lakhs. So my debt component is 2 lakhs, and this I will multiply by 100. So 30,000 you will multiply by 0.7, divide by 2 lakhs, and I will get 10.5%. So I have found the cost of debt. Now if you would have seen the last sum is that I combined the two debt and I calculated the weighted average cost of capital. So here I am going by some another part method where I will not be combining the debt portion. Both the answers are going to come right, but this is an alternative way to solve it. So both ways you will understand. So debt I have done it. Now we have to find the cost of equity. So for equity they have given us the details. So I will be finding the cost of equity. So cost of equity, and they have given us the dividend details. So cost of equity by dividend growth model. So by dividend growth model I will be finding the cost of equity. So the cost of equity says that your future dividend divided by the current market price plus the growth rate, and this you have to multiply by 100. So here I will be putting all the details. So the earning per share they have given us 4 rupees, and out of these earnings the dividend payout is 25%. So what I mean to say is that I will be paying the dividend out of my earnings. So dividend payout is always dependent on earnings. So the earning per share they have given, and the current dividend which I am paying is they have given. So the earning per share is 4 and the dividend payout is 25%. So earning per share is 4 rupees, and the earning per share into the 25% is the dividend which I will be paying it. So 4 rupees, out of 4 rupees 25% I will be paying in the form of dividend. 4 into 25%. So 1 rupee I will be paying in the form of dividend. But what they have given us, they have given us the growth rate. Yes, they have given the growth rate of the dividend to be 8%. So they have given us the growth rate, and since they have given us the growth rate, it is 8%. We are going to find the future dividend. So 8% I will take it as 0.08. So my future dividend depends upon my current dividend and take the factor of growth in it. So my current dividend is D0, which is 1. Then 1 plus the growth factor 0.08. So 1 into 1.08 will give me 1.08. So this is my future dividend. Then they have given us the market price, which is 40. So they have given us the market price, so I can write P0, the market price is rupees 40. So all the details are there, so we can find the cost of equity. D1 we know now, it's 1.08. We have the current market price, which is 40. Then we are going to add the growth rate, which is 0.08, 0.08, and this entire we are going to multiply by 100. So 1.08 if I divide by 40 plus 0.08 and then into 100, so I'm going to get 10.7% as my cost of equity. So I found out the cost of equity also. Now what they have said is you have to find after tax cost of equity. Yes, we have found out. Then after tax cost of debt, that also we have found out. Now they want the weighted average cost of capital. So now we are going to another part, that is the last part, calculation of weighted average cost of capital, which is K0, by using book value as your weights. So book value is the balance sheet value, book value as our weights. Then we have our sources, then the amount which we have borrowed, then the weight of that amount, then the cost of capital in percentage. So cost of capital, so it will be cost of capital in percentage. Then weight we are going to multiply by cost of capital percentage, so we are going to get WACC. So now we are moving further and we are going to calculate. So the sources are that there is a debt component of 4 lakh at 10% and 15%. So there is a debt at 10% rate and there is another debt at 15% rate. So what I have done, I have considered the two debts different. I have not combined them together as I did in the previous sum. Then I have equity and there is nothing else. So the another part which I am having is equity. Okay, so how much is the debt? The debt is 2 lakh and 6 lakhs is the equity. So debt, this portion is 2 lakhs, then this portion is 2 lakhs and the equity component is 6 lakhs. So total 6, 8, 10. So 10 lakhs is the total. So 2 lakhs if I divide by 10 lakhs, so I'll get 0.2. 2 lakhs if I divide by 10 lakhs, 0.2. 6 lakhs if I divide by 10 lakhs, 0.6, and total will be 1. So 10% debt after taking into tax benefit. So the 10% debt after taking into tax benefit, we have come down to 7%. So our cost of capital is 7% here, and the 15% debt, and the 15% debt after taking the benefit of tax has come down to 10.5. So this has come down to 10.5, and the equity cost is how much, which we have taken is 10.7. So the equity is 10.7. Now we are going to multiply this and this. So what I will be doing, 0.2 I will be multiplying by 7, so I'll get 1.4. 0.2 into 0.2 into 10.5, so I'll getting 2.1. 0.6 into 10.7, so this will be 6.42, and this will give me the overall cost of capital. So 1.4 plus 2.1 plus 6.42, so I'm going to get 9.92 as my overall cost of capital. So 9.92% percentage is my overall cost of capital. So this was a very simple sum, and I think before this the sum which I had done it was similar to this sum only. The only difference between this sum and the previous sum was that the two debt portion had combined together and calculated the weighted average cost of capital of the debt only. And this in this sum we have taken the debts. We have not combined the two debts but taken them individually. So now I will be doing another sum. So we will be starting with another sum. So now we are going to move to another sum. So let's start with that other sum. So this is the 19th sum which I will be doing right now. This is your exam sum, and this kind of sum I have already done earlier. Why I am solving it one more time is that since it is an important sum, so we need to practice it more. So this is another, so this is the sum which we have already done. So one more revision will be there for you all. Okay, so now what we are going to do is read the sum. A Limited wishes to raise an additional finance of 30 lakhs for meeting its investment plans. The company has 6 lakhs in the form of retained earnings available for investment purpose, and the following are the further details. The debt equity ratio is 30/70. The cost of debt at the rate of 11% before tax up to 3 lakhs and 14% before tax beyond that. Earning per share is 15 rupees. Dividend payout is 70% of the earnings. Then the expected growth rate in dividend is 10%. Then the current market price is 90. Then the company's tax rate is 30% and the shareholders' personal tax is 20%. Calculate the post-tax average cost of additional debt. Calculate the cost of retained earnings and cost of equity. Calculate overall weighted average cost after tax of additional finance. So this is the sum which I have already done. So one more time it will be a revision. So we require a finance of 30 lakhs. So 30 lakhs is the amount which we require for our investment, and our debt equity ratio is 30/70. So I can say the debt component is 30 and the equity component is 70. So total we have 30 plus 70, we have 100. So out of 30 lakhs, 30% will be the debt. So 30 lakhs, 30% is 9 lakhs. So 9 lakhs amount is our debt portion. So 9 lakhs is our debt, and the remaining 21 lakhs is our equity part. Now we are going to calculate the average cost of additional debt. So cost of additional debt. So how much money we have borrowed is 9 lakhs. So 9 lakh is the total debt which we have borrowed. So this I have used. Now the cost of debt at the rate of 11% up to 3 lakhs. It means 3 lakhs I will borrow at the rate of 11%, and the remaining 6 lakhs I will borrow at the rate of 14%. So now I am going to find the cost of debt for this 3 lakhs amount. So cost of debt at 11% of interest rate, you can write per annum. So your cost of debt will be interest, give the effect of tax savings, so 1 minus tax, divide by the debt which you have borrowed and multiply by 100. So on 3 lakhs I have to pay an interest of 11% per annum. On 3 lakhs I have to pay 11% interest. So 33,000 is the amount I have to pay as interest. and 1 minus, and how much is the tax? The corporate company's tax is 30%. So 0.3 I will take it. And how much I have borrowed? I have borrowed 3 lakhs. So I will be taking here 3 lakhs, and this we have to multiply by 100. So 33,000 into 0.7 divide by 3 lakhs percentage. So the cost of debt will be 7.7%. So from 11% my cost of debt has come down to 7.7%. The cost has come down because there is an impact of tax saving on the interest component. Now we are going to find the same way we are going to find for 6 lakhs. So cost of debt at the rate of 14%, at the rate of 14%. So again, cost of debt, interest, give the effect of 1 minus tax, the tax saving, divide by the debt component into 100. So on 6 lakhs I have to pay a interest of 14%. So 6 lakhs into 14%, so 84,000. So I have to pay an interest of 84,000. 1 minus, the tax rate is 30%, so I will take it as 0.3, and the amount which I have borrowed is 6 lakhs. So the debt part is 6 lakhs, and this I will multiply by 100. So 84,000 into 0.7 divide by 6 lakhs percentage. So 9.8% will be the cost of debt. So we have found the cost of debt. Now they want average. It means we have to combine the two debt. So what we are going to find is the average cost of debt. So what we are going to find, the weighted average cost of capital of additional debt. We are going to find this part. So we have debt at, and another debt we have at, this debt is at 14%, and the other debt is at 11%. So at 11%, the amount which I have borrowed, here the 14% debt I have borrowed 6 lakh rupees. So here I will write 6 lakhs, and the 11% I have borrowed 3 lakh rupees. So here I'll write 3 lakhs. So the total debt which I have borrowed is 9 lakhs. Now I will take the weight. So 3 lakh divided by 9 lakh, 3 lakh divided by 9 lakh is 0.333. This you have to take it as 1. This you take it as a balancing figure. 1 minus 0.333. So it will be 0.667. Then we will have the cost of capital in percentage. So 14% debt, the cost has gone down to 9.8, and 11% debt, the cost has gone to 7.7. Then weight we will multiply by cost of capital percentage. So I'll get WACC. So this into this. So 0.333 I will multiply by 7.7. So I'm going to get 2.5641, and this two I will be multiplying. So 0.667 into 9.8. So I will be getting 6.5366. So 2.5641 plus 6.5366. So it will be 9.1007. This is the combined average cost of our additional debt, which is 9.100. 9.10% I can take it an approximation. So I found out the first part. Now what they have said is you have to find the cost of retained earnings and cost of equity. So we can find the cost of equity. So now we are moving to find the cost of equity, and I will be solving by dividend growth model. So I will be solving it by dividend growth model. So the cost of equity will be my future dividend divided by the current market price plus the growth rate, and this I have to multiply by 100. And here I will be doing the workings. So the earning per share is 15. So they have given me the earning per share 15, and out of this earning I'm paying 70% as dividend. So they have given earning per share, then I know my current dividend paid, and earning per share is 15 and 70%. So 15 rupees is the earning per share, and out of this 15 rupees the earning per share, I am 70% of the earnings I am distributing in the form of dividend. So 15 into 70%. So my current dividend will be 15 into 70% will be 10.5 rupees. Then they have given us the growth rate. So they have given us the growth rate in the dividend, which is 10%. So the growth rate is 10%, or you can take it as 0.10. Since we know the growth rate, so we are in the position to find the future dividend. The future dividend is termed as D1. So your current dividend and add to it the growth factor, which is 1 plus G. So our current dividend is 10.5. 1 plus the growth factor is 0.10. So I will be multiplying 1.10 into 10.5. So 11.55 rupees will be my future dividend. So this I have found out. Future dividend I have found out. Then they have given us the current market price of the share, which is 90. So we know our current market price, which is P0, and it is rupees 90. So all details of the equity are available with us. So we can solve it. D1 is 11.55. Then the pre-0, that is the current market price, is 90 plus the growth rate. So growth rate is 0.10, and this entire we are going to multiply by 100. So what I am doing is 11.55 divided by 90 plus 0.10 percentage. 11.55 divided by 90 plus 0.10, and percentage is 22.83% is my cost of equity. So let me check one more time. 11.55 divided by 90 plus 0.10 into 100 is 22.83. Okay, so this I have found out the cost of equity. Now we need to find the cost of retained earnings also. So we are going to find the cost of retained earnings. So cost of retained earnings will be termed as KR, and I have already mentioned to you that the retained earnings belongs to the equity shareholders, so they are equal to the cost of equity. So cost of retained earnings is equal to the cost of equity, but 1 minus TP. Now 1 minus TP is the personal tax of the shareholder, and I've already explained in the previous sum that the shareholder's personal tax is 20%. So we have a shareholder's personal tax at the rate of 20%. So this part is a tax saving. This part is a tax saving for the company, and it is taxable in the hands of the shareholder. So this is the interpretation which we have done in the earlier sum also. So cost of equity is 22.83. So 22.83 is the cost of equity. 1 minus the personal tax is 20%, so 0.2 I will be taking it. So 22.83 I will multiply by 0.8. So 22.83 if I multiply by 0.8, so the cost is going to fall down, which is 18.264. So I will take it as 18.26% approximately. Now the concept which I need to teach you is that this is the profit after tax. From this we are going to pay the preference dividend, and then the remaining portion will be a part of our retained earnings. Now this profit has already, this part is not taxable since this is profit after tax, so we have already paid tax on it. But in financial management you need to look in a different manner. You have to interpret in the manner in which they have given you the question. So just one thing you remember, that whenever they give you shareholders personal tax, you take in this way that this is the tax saving for the company and it will be taxable in the hands of the shareholder. Like this you have to interpret and solve the sum. So we have found the cost of retained earnings, we have found the cost of equity. Now we need to find the overall, that is overall weighted average cost of capital. So our last part is calculation of weighted average cost of capital, which is KO, using book value as our weights, using book value as our weights. So what we will have our sources, then the amount which we have borrowed, then the weight of that particular amount, then we will have cost of capital in percentage, then weight we will multiply by cost of capital in percentage. So this will be WACC for us. So what are the different sources through which we have borrowed? So one is the debt component and other is the equity component, and there is retained earnings. So there is debt, there is equity, and the third part you can take it as the retained earnings. So how much is the debt? The debt component is 9 lakhs. So debt component we will take it as 9 lakhs. Now equity, what they have given is, how much is the equity? So they have given equity 21 lakhs, and out of this 21 lakhs, 6 lakhs we are having in the form of retained earnings. So we have 21 lakhs as our equity. So out of this equity I will be dividing into two parts. One is the retained earnings, which I am already having with me. So the retained earnings I am having to the extent of I think 6 lakhs. So the amount which I am going to raise from the market is the equity, and from 21 lakhs I am having 6 lakhs with me. So the real amount is 15 lakhs I am going to raise from the market. So the equity component will be 15 lakhs. The retained earnings will be 6 lakhs. So total 9 plus 15 plus 6. So we have total 30 lakhs, which is the requirement of our project. So 30 lakhs is the requirement of our project. So now 9 lakh I will be dividing by 30 lakhs. So I am getting the weight, which is 0.3. 15 lakhs I will be dividing by 30 lakhs. So it will be 0.5. 6 divided by 30 will give me 0.2, and the total will be 1.0. the cost of debt, the combined cost of debt, we have found it. The combined cost of debt, we have found it to be 9.10. So this I will be writing 9.10. The cost of equity, I have found out to be 22.83. So this will be 22.83, and the retained earnings which I have found out is 18.26. So this is 18.26. So this and this I'm going to multiply 0.3 into 9.10. So 2.73 is the answer I'm getting. This and this 0.5 into 22.83. So I'm going to get 11.415. 0.2 into 18.26. So I will be getting 3.652, and the total amount, this is the total overall cost of capital I will be getting. 0.2 into 18.26. Okay, 2.73 plus 11.415 plus 3.652. So I'm going to get 17.797. So overall cost of capital is 17.80%. I can take it. So today in this lecture we have done two sums. I hope you all are following it. So meet you all in our next lecture. Thank you.